Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
All right, so let's dive into something that seems to be like popping up more and more these days in the financial world.
Yes.
SPVs, special
Sure.
purpose vehicles. For anyone who's not familiar. And you sent over some excerpts from Carta's recent report on this. It's called the SPV Spotlight, Private Equity Edition 2024. And great timing because it just came out yesterday.
Oh, yeah. Talk about a treasure trove of data. It's like a peek behind the curtain to see how private equity is changing.
Right, exactly. And that's what we're here to figure out today. What's making these SPVs so popular?
Yeah.
What did they actually look like when you get down to it? And most importantly, why should our listeners even care about all of this?
Well, I think this is more than just like a niche financial tool. The rise of SPVs is really pointing to a bigger shift in how deals are getting done and maybe even how we'll all be investing in the future.
Okay, now you've got me interested. So the report starts off with some pretty amazing numbers, right? Like 116% growth in new SPVs on Carta just in the past 5 years. That's massive. What's driving that?
I think it's a few things coming together. We've seen this private market boom for a while now, but things are changing. Interest rates are higher, fundraising has gotten tougher, and I think a lot of investors are looking for more specific ways to put their money to work. So SPVs kind of fit that need perfectly.
So it's not just that there's like more money out there, but the way that people want to invest is changing too.
Yeah, exactly. Think of it from the limited partner's point of view. These are the people putting money into the PE funds. With an SPV, they can actually co-invest in specific deals alongside the firm, so they get way more control and transparency than they would in a traditional fund structure.
Okay, so it's not like a blind pool anymore,
Yeah.
where you're just committing money without knowing which companies they'll invest in?
Yeah, you got it. They're getting a front row seat to a particular deal.
I see.
And that's a big draw for a lot of LPs, especially now. Plus, SPVs can be a good way for newer fund managers to build up a track record before they go out and raise a whole fund. It's kind of like a testing ground.
That's really interesting. And the report also mentioned that it's not just about a bunch of small deals either. The median SPV size is now almost $22.6 million.
Right.
Up from $15.2 million just a few years ago.
Right. That bigger size reflects the types of deals being done through SPVs now, larger co-investments, and more complicated structures. But what's really crazy is that while less than 10% of SPVs manage over $75 million, they actually account for almost 30% of all the capital raised.
Wow. So just a small number of these vehicles are moving tons of money. Makes you wonder who those big players are. But let's get into the mechanics of it all. So how many LPs are usually involved in an SPV, and what kind of fees are we talking about here?
Well, that's where it gets interesting, because there really isn't a typical SPV. You could have just a few LPs or dozens. It all depends on the deal and the amount of money being invested. For example, the report shows that for SPVs with between 20 and 30 million under management, the number of LPs ranged from just 3 all the way up to 44.
Wow, that's a huge range.
Yeah.
So there's a lot of flexibility built in.
Tons. And the LTs themselves can be anyone from high net worth individuals to huge institutions. As for the fees, about 52% of SPVs that were formed this year charged a management fee, which is actually lower than it was in past years. But for those that do charge a fee, the median rate is somewhere between 1.4% and 2%, no matter how big the SPV is.
So even though there are these huge SPVs out there, the fees aren't necessarily super high.
Not really. Now, you mentioned earlier wondering about who those big players are. And when we look at the differences in fees...
Oh, hold on. That's a perfect place for us to take a quick break. We'll be back in a moment to break down those fee structures and a whole lot more, so don't go anywhere.
And that's where some really interesting stuff starts to happen.
You're killing me. Just tell me, what's the deal with these fees?
All right. So you know how we were talking about those newer fund managers who use SPVs to kind of build up their track record? Well, they're often willing to charge lower fees. Sometimes they even get rid of them completely. just to attract those early investors and get a foot in the door. It's a way to show they can get results without taking a huge cut right away.
Yeah, it's like they're playing the long game, building trust and a reputation. But what about the big firms? The ones that already have that track record? They're not going to be as willing to give discounts, are they?
You got it. Established firms that use SPVs, especially for co-investments. They use their name and their expertise to get fees that are closer to or even higher than traditional fund levels. They can point to their past success and attract investors who are happy to pay a premium to get access to their deals.
So it's almost like there's a two-tiered system now. Different fees depending on who's running the show.
You're right. And it shows how private equity is changing overall. SPVs are making things more complex, but they're also creating new opportunities.
Speaking of opportunity, the report also mentioned how SPVs are becoming like the main way to do co-investments now. Can we talk about that a bit more?
Of course. Co-investments have always existed. That's where an investor puts money directly into a deal alongside a fund. But SPVs make it cleaner and more efficient.
So let's say a PE firm is investing in a company, but some of their LPs are really excited about it. The firm could set up an SPV just for that deal and let those LPs get more involved, right?
Exactly. There are a couple of ways to do this. You have the parallel SPV, which runs alongside the main fund's investment. And then there's the single deal fund, which acts more like a mini fund just for that one investment. Each one has its own pros and cons, legally and tax-wise. But the main idea is the same, targeted exposure.
Okay, so let's say I'm an LP and I hear about this great new opportunity. What's the advantage of using an SPV for co-investment versus just investing through the main fund?
It mostly comes down to control and transparency. In a blind pool fund, you're trusting the manager to pick good companies for the whole portfolio. But with a co-investment SPV, you're choosing to support a specific company, one that you really believe in. You get more insight into how that investment is managed and maybe even more influence.
And for the PE firm, it's a way to keep their LPs happy, right?
Yeah.
Give them a chance to invest more in the deals they're most excited about.
Exactly. It builds stronger relationships and can make it easier to raise money later on. If an LP had a good experience co-investing through an SPV, they're more likely to invest in the next fund.
That's smart. You know, this reminds me of when I first heard about angel investors using SPVs for startup deals a few years ago. Back then, it seemed like a really niche thing. But now, seeing how SPVs are changing, it's like a whole new world.
It really is. And it's not just limited to private equity anymore. Venture capital firms are using SPVs more and more too, especially for those later stage deals right before an IPO.
That makes sense. VC is all about getting in early on those companies with huge potential. And an SPV is a fast and flexible way to do that.
You got it. And remember how we talked about those economic changes earlier? Well, SPVs give investors more control when things are uncertain. They can be selective, focusing on industries or companies they think will do well, even if things get rough.
So it's like having a more precise tool to navigate the market, instead of just going with the flow of a broad fund. But with all this talk about control and flexibility, it makes me wonder, are there any downsides to SPVs? Are there risks investors should be aware of?
That's a great question, and it's one we should definitely talk about more. One thing to keep in mind is that when you're focused on specific deals like that, are you losing out on the benefits of diversification that you get with a regular fund?
Yeah, that's a good point. If you're putting all your money into one company or just a few, isn't that riskier? What if that company runs into trouble?
You're exactly right.
Then your whole investment goes down with it.
That's why it's so important to do your homework with SPVs. Investors need to look beyond the hype and really dig into the numbers, the market, the management team, everything. You're not relying on the fund manager's entire portfolio to balance things out. So you have to be extra sure about that specific opportunity.
You know, given your experience with analyzing early stage tech companies, I bet you've seen this a lot. Do you approach due diligence differently for an SPV compared to a traditional fund?
It's all about digging deeper. With a fund, you're looking at the manager's strategy, their track record, how they put their whole portfolio together. But with an SPV, you're zeroing in on that one company. You're looking at their competition, the regulations they have to deal with, even their key people and if they can get things done. It's much more detailed.
So it sounds like SPVs require investors to be more hands-on. You can't just sit back and watch.
That's a great way to put it. And that leads to another important point, liquidity. SPV investments are usually illiquid, which means you can't easily sell your stake before the vehicle closes down, which typically happens with an exit like an IPO or a sale.
Yeah, that makes sense. If you're invested in just one company, you're stuck with them. No quick profits if the market changes.
Right. So you need to make sure your investment timeline matches up with when that SPV could actually pay off. If you're looking for short-term gains, SPVs probably aren't the way to go.
All right, so we've talked about the risks and liquidity. What about fees? We mentioned before that management fees for SPVs can vary. But are there any other costs that investors should be aware of?
That's a good question. It's easy to just focus on the management fee, but there are legal and administrative costs involved in setting up and running an SPV. Things like writing up the operating agreement, getting tax advice, ongoing accounting and reporting. These costs can really add up, especially if the structure is complicated or involves different countries.
So even if the management fee seems okay, those extra costs could cut into your returns.
Absolutely. Transparency is key here. Investors need to ask for a clear breakdown of all the potential expenses before they commit any money, not just the main fee.
It's like those budget airlines. Sure, the base fare is low, but then they charge you extra for everything else.
Yeah, exactly. But seriously, this is where experience and having the right knowledge really matters. A smart investor or someone who's working with a good advisor will know what questions to ask to uncover those hidden costs.
This has been so informative. We went from SPVs 101 to really getting into the details.
Yeah, it's been great.
The good, the bad, the potential.
And I think it shows a bigger trend in finance. People want more customization, more control. They want to invest in things that align with their values and goals.
Right. We said earlier that the rise of SPVs shows a shift. And now I see it. It's not just about making money. It's about making smart choices that reflect your values and how you see the market.
I couldn't agree more. And as private markets become more accessible to everyone, I think this trend is only going to grow.
Well, thank you so much for sharing your expertise with us. And a huge thank you to our listener for suggesting this deep dive. It's been fascinating.
My pleasure. And remember, whether you're a seasoned investor or just starting out, staying curious and informed is the best way to stay ahead in the world.